This is Andrew Stotz, and I'm going to take you through Warren Buffett's letter to shareholders. It's April 8th, and he wrote this and published it on February 26, 2022. I just went to the website of Berkshire Hathaway, which you can see right here, and I started downloading the information to understand. So what I did is I took the letter to Berkshire Hathaway shareholders, and I took the text of that and I put it into a Word document. So I'm just going to run through it. But before I do, I thought I would just talk a little bit about long-term performance, since that's what he's talking about, as the first page of the letter. In fact, I show that first page right there. Now, you can go to the website and see that. I put it into some chart format to help us understand. This is the most significant thing, is basically what we're talking about is a massive return. The blue line is the S&P 500, and it's just down at the absolute bottom here versus Berkshire. What does this mean? Well, this is going back to basically the first return that we have from him is in 1965. So I started in 1964 and then carry the return from end of 1964 onwards till today. And what we can see from this is that the compound annual gain from 1965 to 2021 for Berkshire Hathaway has been 20%. For S&P, it's been about 10. In other words, it's 2 times higher. His performance is 2 times higher than the S&P 500. It's also a great benchmark when you hear people talk about how much do you want to earn on average every year. If you hear anybody say more than 20%, you now know, geez, you're going to be better than Warren Buffett. But here's what's really fascinating. He shows in the table that basically what would happen is that the money in that fund in Berkshire Hathaway would have grown to $3.6 million, and that's a difference compared to S&P 500, which would be 30,000. So what we can see is that if the return is 2 times larger, 20 versus 10, you're going to get 121 times larger terminal value if you leave the money in for 57 years. Now, Buffett outperformed 38 of those 57 years, but that also means that he underperformed 19 times, 19 years. That's a success ratio of 67%. So if someone comes to you with an investment strategy and they say it's a 80% success ratio, you know, wow, that's even better than Buffett, and it's probably unlikely. Or it could be just driven by chance. Now, I really wanted to go through it and look at the best years and worst years to understand what's going on. So we can see the best year was 1976 when it was up 129.3%. And we can see that the S&P's best year was 1995 when it was only up 37.6%. And finally, in 1976, Warren Buffett outperformed. So you can see Berkshire Hathaway, BRK, minus S&P 500. I just subtracted Berkshire Hathaway from S&P 500, we can see that Berkshire Hathaway Buffett outperformed in 1976 by 105.7. Now, the next key number is in 1979, we can see that Warren Buffett had a 102.5% return. And that, if we look at the second best return for Warren Buffett, it was 100%. Second best return for S&P 500 was 37. That's because it's a diversified portfolio of 500 stocks. It just can't produce massive results. But a small, concentrated portfolio, as Warren Buffett has, was very significant. Now, also, you'll take a note that the numbers that we have from him about the return started in 1965. And by 1976, he had his best year. One of the lessons here, and this, the 1979, he had his second best year. You don't see any of his best years happening recently. One of the most important things that you want to think about when it comes to this type of stuff is that you really want to be lucky and get some good times in the first years. All right, now let's look at the worst. That's the next table at the bottom. And you can see his worst was 48.7. That's a pretty heavy drawdown. Hey, 1974, he lost 50% of your money. And then in 2008, he lost 32%. But look at the S&P, you can see it lost 37% in 2008, and in 1974, it lost 26%. Again, the drawdowns are less for S&P 500 because it is a diversified portfolio. And also we can see that the 1999 was really the worst as far as Buffett's performance relative to the S&P 500, where he underperformed by 40.9%. What was happening in 1999? That was the dot-com boom and bubble. And in those days, basically, Buffett said, I'm not invested in that stuff because I don't understand it. So he didn't capture the upside, but he definitely got some great returns on the once all of that stuff started crashing. So this gives us a picture of returns. Imagine if you had to go to shareholders and tell them, we're down 48.7%. Buffett's been down that much, but only twice was it really severe, 1974 and 2008. Now, this is where it gets interesting. What I really wanted to do, we've already seen a chart showing Buffett's performance over this whole period of time, 57 years, but I wanted to look at it by decade. So let's start each decade at 100. And here we can see that if we start the first decade of his performance, when we look at Berkshire Hathaway, it went up quite a bit, up to almost 500, roughly getting close to 450, 500, but then it was right back down at 200. So whether it was the S&P 500 or Berkshire Hathaway, they both started off with $100 in 1965, the year I was born, and they ended up with very close. Buffett was just 2 times higher. Now let's look at the next decade, and we can see if we, again, rebase to 100, we can see this was the time that Buffett really, really gained the most. Here you can see he's now got 3,000% improvement, or he's gone from 100 to 3,000, a massive outperformance relative to the S&P 500. There it is. Without the decade or the period of time from 1975 to 1984, it's hard to say that Buffett would have had such great performance at this time. Now, also in the third decade, that's 1985 to 1994, he did also outperform pretty strongly, got up to 800 starting at 100, and that's a significant outperformance relative to the S&P 500. Now, let's look at the decade number 4. That's from 1995, and we can see, okay, it was a bit choppy. He underperformed, as we said, in 1999, but he started to get that back, and then the markets kind of crashed. The S&P 500 crashed after 1999, and he came out on top at taking 100 and getting to about 250, maybe 290, a little bit of outperformance relative to the S&P 500. What about decade number 5? Well, that's the one we just been through a while ago, and that basically he showed mild outperformance relative to the S&P 500. I would say if you only looked at his track record in this period, you'd say, yeah, he's a pretty good stock picker, not bad, but not sensational in that period. Well, what about this most recent decade? The past 10 years, what we can see is that, in fact, not only was decade number 5 a pretty weak performance, a little bit of outperformance. It's not bad, but it wasn't like some massive outperformance. And here we can see in decade number 6, it was actually underperformance. Now, what are we supposed to take away from this? Am I saying that Warren Buffett is a bad investor? No, he's pretty much one of the best investors of all time. And yet, what we can see is that he's going to have decades where he's not going to have amazing performance. The main thing that we can take away is that he did have great performance in the 70s and into the 80s a bit. And that was fantastic. He also missed the downturn that happened in 1999 and the crash that happened after that. But more importantly here, we can see that it's been hard for him to outperform. Why? His size is huge. But ladies and gentlemen, you don't really need to outperform that much in recent periods if you've had good performance in the beginning and you just keep your money in the market. And that's what the secret of what Buffett did. He let the power of compounding work for him, and he ends up with this massive return, which we can see there. So even when we look at the decades, it's important to recognize that time in the market is the key. You want to be invested in the market for, how about 57 years? That would be amazing. And here, it's a concentrated portfolio. Now let's go in and look at the first thing I want to look at besides performance. This section, I say his job is to increase the intrinsic value of the share. That's what Buffett sees. And I've highlighted in bold here the thing I want to talk about as I go through this. So our position carries with it the responsibility to report to you what we would like to know if we were the absentee owner and you were the manager. We did, though, make reasonable progress in increasing the intrinsic value of shares. This task has been our primary duty for 57 years. So there you have it. His task is increasing the intrinsic value of shares. But there's a problem. Nobody knows the intrinsic value of shares. So we do know the book value, which is based on historic values of assets minus liabilities on the balance sheet. Of course, some balance sheet items are stated at market value, but generally most are not. Now, all of this red text that I'm talking about right here is me taking some notes and making some notes. If you see black text or gray, it's coming from Buffett. Now, over the long run, the average U.S. company is traded at about 2 times price to book. If we consider a hypothetical company that has a book value of $100 per share, on average, the price would be $200. That's a very rough estimate of the value of all companies in the stock market by saying they're 2 times the book value. Now, millions of market participants set the price, and sometimes it's spot on, but most of the time, the share price is bouncing up and down. The degree to which a company is able to earn a return on capital that's higher than its cost of capital determines how wide the gap is between the book value per share and the price per share. We call this the price to book value. Now, what I would also say is one thing that you could probably say with a high degree of certainty is that the percent increase in the book value could roughly equate to the increase in the theoretical intrinsic value. So let me summarize. Buffett says his job is to increase the intrinsic value of the company, but truthfully, no one knows the intrinsic value, including Buffett. We all make estimates for that. And therefore, a lot of times he talks about the proxy being the increase in the book value per share. So let's move on to the next thing. Buffett is not a stock picker. Let's quote from his letter. Our goal is to have meaningful investments in businesses with both durable economic advantages and first-class CEO. We own stocks based on our expectations about their long-term performance and not because we view them as vehicle for timely market moves. Charlie and I are not stock pickers. We are business pickers. This is a very clear indication. What he likes is durable economic advantages. The CEOs, ultimately, he is focused on business. Also, he says that, well, we have a collection of companies and some are truly extraordinary. We have some that are good and we have some that are marginal. And that's amazing because you think that he's hitting home runs all the time. He's not. There are plenty of companies in his portfolio that aren't that spectacular. And that's a good lesson for any stock picker out there. Don't expect that every single stock is going to be outperforming all the time. Now, one advantage of our common stock segment is that on occasion it becomes easy to buy pieces of wonderful businesses at wonderful prices. Now, he's talking about common stock segment. What he means is he's able to buy shares in the market. When the market crashes, he can go in and buy shares of business at wonderful prices. Now, he's also saying it's very rare on negotiated transactions that you could do this. It's going to be a one-on-one negotiation. Now, it's also far easier to exit from a mistake if it's in the marketable arena, meaning if it's a listed company in the stock market. You can exit it and just get out, but you can't do that so easily with a private company. Let's go into the next topic, and that is massive investments in fixed assets. Here he says Berkshire owns and operates more U.S.-based infrastructure assets classified on the balance sheet as property, plant, and equipment than are owned and operated by any other American company. The supremacy has never been our goal. It has, however, become a fact. At year-end, those domestic infrastructure assets were carried on Berkshire's balance sheet at $158 billion US. Now, he's calling them infrastructure assets, but we generally call them property, plant, and equipment. They are the fixed assets of the business. In fact, that number of 158 is nearly 1% of GDP. Geez, that's my little addition to this. Now, I went to the financial statement. In fact, we can go to the webpage and we can find the financial statements either in the annual report or in the 10K form right here. And then we can go down and look more detail. For instance, I went into the consolidated balance sheet right there. And from that consolidated balance sheet, I looked at all of these classifications and I grouped them into some different classifications just to make it a little bit easier. So what you see is he has $88 billion in cash, $59 billion in U.S. Treasury bills, meaning very short term. And then there's this mixed account between kind of short-term, long-term, fixed income, which I've included in cash because it's not like it's an investment and like it's not like buying a stock in particular. So I'm saying there's about $163 billion in cash that's roughly available. And then you can see the rest is 368 is in equities. Those are the stocks that he owns. And then property, plant, and equipment is 176. Then we have goodwill, meaning that the holding company of Berkshire Hathaway has paid more than the fair value for some companies, and it's booked as goodwill. But that's not a lot of goodwill that he's gotten there. So this is the consolidated financial statement of Berkshire Hathaway, meaning if they own a large share, more than 50% of a particular company, then they're going to consolidate that in here. Now, what I teach in my valuation masterclass is that value comes from long-term assets, and more specifically for traditional companies, from fixed assets. Now, here we can see that in his case, I've added up a couple different areas in the balance sheet. So his number of 158 is a little bit lower than my number of 176. And I'm just doing it for simplicity purposes. Let's take his word and his tables as right. But here what we can see is that his property, plant, and equipment accounts for about 18% of total assets. Now, what I did to try to understand this is I collected a balance sheet, financial statements over 19 years of 12,000 companies across the world. And what you can see at the top is I looked at an average over these 19 years to calculate a common size balance sheet. And what you can see is that current assets account for 36% of the balance sheet. Long-term investments, meaning ownerships in stocks, well, that's huge for Buffett, but it's actually very small for most companies, only 3.5% of total assets. But most importantly, I wanted to highlight the net fixed assets here, which account for 32.2% of the total assets of the average large company in the world. So even though he's saying that it's a lot of fixed assets, it's actually low at 18%. Why is that? Because most of his holdings are through holdings of other companies, and therefore you're not consolidating those fixed assets there. So let's continue on and go to the next one, which is Berkshire pays its taxes. In 2021, for example, we paid $3.3 billion, while the U.S. Treasury reported total corporate income tax receipts of $402 billion. In other words, we pay our taxes. Now, I created a small P&L. Again, what I did is I went to the financials in the annual report, and here's the P&L, and I went through and I added it up, and I summarized a lot of it to bring it into a simple format that we all can understand. And here we can see revenue of 276. There's some investment revenue of 79, total revenue of 355. Then there's costs, and this cost includes interest, but interest is very low. But in the end, you can see that the amount booked for taxes is about 21, which means it's about an 18.7% tax rate. Now this comes from the calculations from the notes. So I went to note number 19. In fact, you can go and just go to Control F and say note 19, and it should hopefully take us there, but it didn't. So let's see. I'll just go in and we can go down and just search through the financial statements until we get to note number 19, sorry. And where are we? There it is, around here. Okay, that's 25. So now we can go and look at 19. And here is 19 where it's talking about taxes. So I went through all this tax information here to try to understand about the taxes of the company. And what did I conclude? Well, they've got about $90 billion in deferred tax liabilities that they're going to have to pay. Now, there's a lot of different issues about taxes, such as owning shares of companies outside of America and whether you repatriate that and when you pay taxes. But that gives you a picture of what's happening. Now, let's continue on and look at the next section, and that is float is extremely valuable, especially to a master stock picker. Now, Buffett says from 8.6 million purchase of National Indemnity in 1967, Berkshire has become the world leader in insurance float, money we hold and can invest, but that does not belong to us, including a relatively small sum derived from life insurance. Berkshire's total float has grown from $19 million when we entered the insurance business to $147 billion. Now, this is a secret of Buffett, really, is that ultimately an insurance company is taking money in premiums, holding that as a reserve, investing it over time, letting it grow, and then knowing that they're going to have to pay out a portion of that. So because Buffett is so good at investing, basically having that float and investing it is significant. Now, he also says, of equal importance, float is very sticky. Funds attributable to our insurance operations come and go daily, but their aggregate total is immune from precipitous decline. When it comes to investing float, we can therefore think long term. Now, in many countries, you do have restrictions of how much equity that an insurance company can hold. But here we can see that he's talking about using a portion of that float to invest. Now, he also mentions that a buildup of value that is important to Berkshire Hathaway owners is not reflected in GAAP earnings. And so he's talking about how we can understand float. Now, he does in this section talk about Ajit Jain, and I just included from Wikipedia, but it's a funny story. It says that we met on a Saturday morning, and quickly I asked Ajit I'll just highlight that. I asked Ajit what his insurance experience has been. He replied, none. I said, well, nobody's perfect, and I hired him. And basically, Ajit has run that business for 35 years. So that's a pretty impressive story. I love the stories that he tells in here, and that's part of what makes him a great communicator. Now, Buffett invests in conglomerates if they have good CEOs. In the in the public markets, we don't, if you invest in a conglomerate, we usually say there's a conglomerate discount. So if a conglomerate, the sum of all the parts of the conglomerate is equal to 100, some people may say, well, that should trade at 90 or 80 in the stock market. But that's not the way that Buffett looks at it. Now, here he's talking about his four giants. He talked about insurance a bit, and here is Marmon Holdings. This is a company I actually never heard of, but they own 100 different companies, 11 groups. And what you can see is that it's a pretty significant company. And what you can see from this is that you can go to the website of the company, but this is a conglomerate. And if a conglomerate is well managed, he'll invest in it. And I suspect that, if you have a conglomerate and you like what it's producing, you may be able to find it cheap in the market. All right, let's look at insurance. Has long-lasting with a sustainable moat. Now, what he says about the insurance business is the product will never be obsolete, and the sales volume will generally increase with both economic growth and inflation. Also, integrity and capital will be important forever. And finally, he finishes up about the insurance by saying replication of Berkshire's operations, however, would be almost impossible. That is an economic moat. Now, part of that is because it's very long-term thinking in the way that they invest that float. Let's move on to the next section. His increased stake in Apple happened without buying any new shares. He's talking here about Apple, and what he's talking about, in fact, I meant to highlight that as black, but consider that each 0.1% of Apple's 2021 earnings amounted to $100 million. We spent no Berkshire funds to gain our accretion, meaning that they gained from 5.55 up from 5.39. That tiny amount that they gained didn't come from buying any shares. It came from repurchases of shares that happened at Apple. He let other people repurchase the shares that Apple had offered to buy back. Now, next we look at another big one is BNSF, and it's a bet against a virtual world, and it's a bet for a green world. Now, BNSF is basically number one artery of American commerce, as he calls it. If the many essential products that BNSF carries were instead hauled by trucks, Americans' emissions would be massive. So here is some branding of, you can see, Burlington Northern Santa Fe Railroad is where it originally came from. And today's BNSF Railway is the product of nearly 400 different rail lines that were merged or acquired over the course of 170 years. Now, that is a company that has existed for a long, long time. So Buffett definitely does not like EBITDA. Here he's talking about his calculated interest and he's calculated basically earnings after interest and taxes. He said, our definition suggests a warning. Deceptive adjustments to earnings, to use a polite description, have become both more frequent and more fanciful as stocks have risen. Less politely, I would say that bull markets breed bloviated bull. The point is, he doesn't like EBITDA. Now, let's just look at the case of Berkshire Hathaway. I made this simple P&L, and I showed you it before, but I'm going to add in depreciation here. We can see that depreciation is $11 million. Now, interest costs and that type of stuff is pretty low for Berkshire. They don't really borrow that much money. So the point is that you could add back depreciation, and the 91 in net profit could be higher. And that's where it's EBITDA that we're usually talking about. And it's such a common term in the world of finance. But really what Buffett cares about is what profit is available at the end of the balance sheet, of the P&L. And you can see $91 billion in 2021. Now, I also decided that why don't I look at the income statement of all companies. This is 12,079 companies across the world. And we can kind of get a picture of what the P&L looks like. Here, this is a common size P&L, and we can see that the net profit margin is 5.7%. Now, we don't get depreciation, but we can see interest income or interest expense is about minus 1.5, and you probably would add back another 1 or 2 in depreciation to get the EBITDA. So now, no greenwashing at BHE. From Wikipedia, Berkshire Hathaway Energy is a holding company that is 91.1% owned by Berkshire Hathaway. And basically, this tells you a little bit more about it. It serves 4.9 million retail customers, generates 29 gigawatts of power, and transports 8.2 billion cubic feet of natural gas per day over 16,000 miles of regulated pipeline. And BHE, our final giant, earned a record $4 billion in 2021. That's up from more than 30-fold from the $122 million earned in 2000. That's the year that Berkshire first took a stake. Now, of course, they own 91%. Now, he talks about, because he loves the idea of great CEOs, he talks about David Sokol's and Greg Abel's leadership. And BHE has become a utility powerhouse and a leading force in wind solar transmission. And he basically ends it by saying, not in any way of these currently fashionable greenwashing stories. How many companies do we see that are getting on the ESG bandwagon and potentially greenwashing, meaning they're just making it look like they are really good with the environment? Now, the next section is Todd and Ted's excellent adventure. Again, what he's going through now is the 15 largest holdings. And basically, he's attributing some of them to longtime investment managers Todd Combs and Ted Weschler. And these guys, of course, work with Berkshire Hathaway. And they had a total authority in respect to about $34 billion of investment, which makes them a massive fund manager. It's kind of small in the context of Berkshire Hathaway, but it is pretty massive for the rest of us. So let's just look. I took a table that he produced, and I broke it down. And what you can see is that I've ranked this table by market capitalization, which shows that of the top 3 companies, 2 of them have the derivation of the word America. That's Apple, Bank of America, American Express, the Coca-Cola Company, and Moody's. Those are the top 5 companies in the shareholding. But also there's Chinese company, and let's just look at that for a moment. Now we can see I also added into this table that the difference, and we can see the biggest gains were at Moody's, the biggest gains were BYDI from China, and then we have American Express and Coca-Cola companies. So even though he has made very good gains with Apple, it's only 418%. Okay, so I just included in here a little bit about BYD, Build Your Dreams, which is a Chinese conglomerate manufacturing company headquartered in Shenzhen in Guangdong, China. And they do a lot of different stuff related to automobiles and electronic, as well as solar panels and the like. And then what's also interesting is he's investing in Japanese companies, in particularly the Itochu Corporation, which dates back to 1958, when basically they started in a trading business. And so they're engaged in domestic trading, import, exports, all of these types of things. So a trading business, interesting to see him getting into that. And let's continue on and go to the next section. Nearly 2% of cash as the top 14,000 companies globally. Wow. So what we can see here is that the balance sheet of Berkshire Hathaway, he talks about the fact that the company has $144 billion of cash. Now, you're never going to get exactly to that point. You can see it comes to $147 in cash on the balance sheet. If I add together the cash and the UST bills, That's about 1.7% of all the cash that exists on the balance sheets of 14,296 of the largest companies in the world that I'm keeping data on. This is a war chest of cash. Now let's think about what's he going to do. Well, he is cashed up, and what does he say? My favored status throughout the period was 100%, meaning 100% allocated to equity. And Berkshire's current 80% or so position in equity is a consequence of my failure to find entire companies or small portions thereof which might meet our criteria for long-term holding. He just can't find anything that's big enough and attractive enough on a pricing perspective, so therefore he's not adding to that. He's holding 20% of the balance sheet in cash. So if someone out there thinks, whoa, markets could crash, the minute those markets crash, you could see that Buffett starts to pick up shares in different companies. Because Buffett is lying in wait. That's what I say. He says, increase the long-term earning powers of Berkshire's controlled businesses through internal growth or making acquisitions. That's it. We either grow internally or we buy companies that are growing. Today, internal opportunities deliver far better returns than acquisitions, partially because acquisitions are expensive. And the size of those opportunities, meaning the internal, how to improve and grow organically, they're small compared to the resources that Berkshire has. They've got $144 billion ready to be deployed. Now, from time to time, such possibilities are both numerous and blatantly attractive. Today, we find little that excites us. What he's saying here is that the share prices in the market are not yet low enough that he is attracted to buying right now. Next thing, a valuation truism. Low rates drive up valuations. What does Warren Buffett says? That's largely because of a truism. Long-term interest rates that are low push the prices of all productive investments upwards. Other factors influence valuation as well, but interest rates will always be important. Let's move into the next one. Use share buybacks when the price is right. Buffett says, when the price-value equation is right, the path is the easiest and most certain way for us to increase your wealth, meaning share buybacks. He wants to buy when the share is down below or around the value. During the last 2 years, we therefore repurchased 9% of the shares that were outstanding, and the expenditure left our continuing shareholders owning about 10% more of all the businesses. So it reduced the number of shares outstanding. Our shares must offer appropriate value, or else he's not going to buy. If he thinks that Berkshire Hathaway shares are too expensive, it doesn't make it. In fact, he would say that it's value destroying if we overpay when we're buying Berkshire's shares. So when those shares come down, expect that he is going to buy more, but not when markets are high or that share price is high. But Berkshire shareholders are reluctant to sell their shares. He calls his shareholders a high-class investor base. If our shares were heavily held by short-term speculators, both price volatility and transaction volumes would materially increase. What does that mean? He could do more buybacks because people are crazy. Mr. Market wants to dump the shares. That's when he wants to buy it. But in fact, that's not the case. Unfortunately, his shareholders are not like that. Now, as it happens, he says repurchases automatically increase the amount of float per share. The figure has increased during the past 2 years by 25%. So basically, when he's buying back shares, he's leveraging up the float, and that gives higher returns. Now, towards the end of the letter, he gives a tribute to Paul Andrews, the founder of TTI, who has passed away. And what's fascinating, he always talks about the great CEOs, and he said that Paul quietly displayed all the qualities that Charlie and I admire. He goes on to tell the story of Paul Andrews, and he even said, when Paul met me, he explained, now this is this great story about what happened to the purchase of his business. Paul explained why he had eliminated these two alternatives as buyers. He then summed up his dilemma by saying, in far more tactful phrasing than this, after a year of pondering alternatives, I want to sell to Berkshire because you are the only guy left. So I made an offer, and Paul said yes. One meeting, one lunch, one deal. That's how Buffett does a deal. That's amazing because we always think of all the due diligence and the pricing. He doesn't go through all that according to what he's saying here. Now, the next thing he talks about is luck. And he said, if Paul and I had not enjoyed a mutual friend, Joe Roach, TTI would not have found its home with us. And he goes through talking a little bit about luck. Next, after that, He talks about BNSF from taking it from a public company to a private company in 11 days. Basically, he tells the story of being down in Texas, meeting with the head, Matt Rose, of CEO of BNSF, and he says that the market basically crushed the share price while he was down there. Basically, the economic outlook was bleak, and Wall Street wasn't friendly to railroads or much else, so the share price got crushed. On the following day, I again got together with Matt and suggested that Berkshire would offer the railroad a better long-term home than it could expect as a public company. I also told him the maximum price that I would pay. Matt relayed the offer to his directors and advisors. 11 days later, Berkshire and BNSF announced a firm deal. And here, I'll venture a rare prediction. BNSF will be a key asset for Berkshire and our country a century from now. Wow. Amazing how quickly he does things. Now, he mentions a section about teaching and how it helped him clarify his thoughts. And I totally get this as a teacher myself. He says, teaching, like writing, has helped me develop and clarify my own thoughts. I love that because, what is his hallmark? He explains things so simply. Next, Buffett is giving some advice to youth. Find the right field and good people. Talking to university students is far superior, he says. I have urged that they seek employment in, one, the field, and with the kind of people they would select if they had no need for money. So do what you love, not what makes you money. Of course, he says economic realities, I acknowledge, may interfere with this, but even so, I urge the students to never to give up the quest, for when they find that sort of job, they will no longer be working. And he talks about, finally, at Berkshire, we found what we love to do. That's Charlie and Warren. In our home office, we employ decent and talented people, no jerks. That's the awesome policy. I love that. He also says, I would like, however, to emphasize a further item that turns our jobs into fun and satisfaction, and that is working for you. Again, as a business owner, he sees you as a shareholder and a part business owner. And finally, he talks about the benefit of long-term individual shareholders. To an unusual, truly unusual degree, however, Berkshire has as owners a very large corp of individuals and families that have elected to join us with an intent to approaching it till death do us part, meaning he has shareholders that are going to hold forever. And people who are comfortable with their investments will, on average, achieve better results than those who are motivated by ever-changing headlines. So he really likes his investor style that are investing in his company. And he calls them long-term individual owners, are both the partners Charlie and I have always sought and the ones we constantly have in mind as we make decisions at Berkshire. And finally, to wrap it up, he highlights that the annual meeting's coming up the 29th of April to the 1st of May. And he calls it's an annual gathering of capitalists in Omaha. And he finishes his whole newsletter with a sales pitch. Well, there you go. That's February 26, 2022. Warren Buffett, the chairman of the board of Berkshire Hathaway, and everything that I could pull out of what he said in his letter to investors. Let me know what you think about this in the comments below.